One strategy caps your max loss up front, while the other offers faster profits but exposes you to theoretically infinite risk. Here is exactly how to choose. Both the Iron Condor and the short Strangle are neutral strategies designed to profit from time decay and dropping volatility. You sell them when you think the market won't move much. However, their risk profiles are completely different. Let's define the short Strangle first. This involves selling an out-of-the-money call and an out-of-the-money put. You collect a premium up front. If the stock stays between your strikes, you keep it all. The Iron Condor is essentially a Strangle with training wheels. You still sell the call and put, but you also buy further out-of-the-money options to act as insurance wings. This defines your risk. Here is the visual difference. The Strangle has undefined losses if the stock moves too far. The Iron Condor flattens out. No matter how far the stock drops, your loss stops at the long wing. Why would anyone choose the undefined risk of a Strangle? The answer lies in probability and management. Strangles generally have a higher probability of profit, pop, because you don't have the drag of buying insurance. In a Strangle, your break-even points are wider. You collect more credit because you aren't spending money on those protective wings. This gives the stock more room to move before you lose money. However, the black swan risk is real. If a market crash occurs, a short Strangle seller faces massive margin calls. An Iron Condor seller knows exactly how much they can lose at entry. Let's look at the maximum loss math. For the Iron Condor, it is simply the width of your spreads minus the credit received. It is a fixed number. For the Strangle, the risk is theoretically infinite on the call side, as stocks can rise indefinitely. On the put side, the stock can go to zero. You must have the capital to handle this variance. Capital efficiency is the next major differentiator. Iron Condors are capital efficient. They only require margin equal to the max loss. Strangles require significant buying power reduction, BPR. Because Strangles require more capital, your return on capital, ROC, might actually be lower than an Iron Condor, even though the total dollar profit is higher. It is a game of leverage. Now, let's talk about theta, or time decay. Both strategies benefit from the passage of time. However, the long options in the Iron Condor work against you, slowing down the decay slightly. Management is where the Strangle shines. Because there are no long wings, you can easily roll a tested side. You can move your strikes to collect more credit and extend the duration. Iron Condors are harder to adjust. If you try to roll a losing Condor, the long wings drag on the price. Often, you have to pay a debit to roll, which locks in a loss. This creates a paradox. Iron Condors are safer regarding catastrophic risk, but Strangles are safer regarding the probability of avoiding a loss through management. So, when do you choose the Iron Condor? Use it in lower volatility environments, or if you have a smaller account size, under $25,000. It preserves capital. When do you choose the Strangle? Use it when implied volatility, IV, is high. The high premiums cushion you against moves, and you need the flexibility to roll if the market stays wild. A critical warning regarding Strangles. Never trade them in an IRA or cash account where you cannot use leverage efficiently. The capital requirement makes it mathematically inefficient. Also, consider legging in. You don't have to enter all four legs of a Condor at once. Some traders start with a Strangle and buy the wings later if volatility expands or they get nervous. Profit targets differ slightly. For Strangles, we typically aim for 50% of max profit. For Iron Condors, because they are harder to manage, many traders take profit at 25% to 50% to reduce risk exposure quickly. Let's summarize the decision matrix. If you fear a black swan event or have limited capital, the defined risk of the Iron Condor is non-negotiable. If you have a large margin account, high option approval levels, and the skill to actively manage and roll positions, the Strangle offers better long-term probabilities. Ultimately, the best strategy is the one that allows you to sleep at night. A profitable strategy that causes panic selling is a failed strategy. Start with Iron Condors to master the mechanics of multi-leg options. Once you understand the flow of premium, you can graduate to Strangles if your account size permits. Respect leverage, define your risk, and trade small.